Have you ever wondered why when you're trading, the results are going smooth and then all of a sudden things does start to fall off a cliff? Your results just start to erode, and it's not a discipline issue, and it's also not bad luck. That's because it's something called alpha decay. So in this video, we're going to be talking about alpha decay and how this affects trading strategies. You know how hedge funds or institutions try to beat the S&P 500 in terms of returns? So the excess amount there is called alpha. Now, alpha decay is as your excess over a benchmark starts to erode, and then you're not performing as good as even the S&P. And then that raises the question is, why should I do this and put so much effort into it when I can just get the same results putting it passively in the S&P in an index fund? So alpha decay usually happens when strategies get overcrowded. Too many people are trading it. And you might think, oh, retail traders don't affect the market, but they actually do. If everybody trades the same strategy and it's overcrowded in certain areas on the chart, then they will get manipulated and liquidity will be taken from these pots. It's not because they're hunting you, it's that they're placing orders in places that have higher liquidity so they can actually place their bigger, large size positions. It's like a gold rush. So the first miners who are getting to this cave or whatever gets all the money, and then the rest that come after, they're the ones that are left with nothing, right? So this is how things happen in the market. Why do you think hedge funds and institutions and banks pay quants to develop algorithms that are so advanced that alter strategies based on certain conditions? That's not for just random reason. That's because to keep the alpha above the benchmark. Your strategy loses edge because markets evolve. You might have a trending strategy and then all of a sudden it doesn't trend all the time. It starts to consolidate more. Liquidity gets swept at different times. Liquidity gets swept and injections happen even further than it usually had before. So the market tends to move and shift, and that's why I generally do not believe that anybody that says, especially if they're a retail trader, that they have a 100% mechanical strategy. I don't believe that at all. There's no way that everyone is trading this mechanical strategy like a robot and also teaching you it. It's not how it happens, right? The way I trade is I trade using a bit of mechanical just for rules, and then I use my intuition on top. And I always talk about how intuition is important and you need skin in the game, understanding, getting used to different environments, volume times, how the market moves in certain conditions, and adapt your strategy based on this. Don't have a fixed 20 pip stop loss, because that's gonna again have that alpha decay, because you're gonna keep taking that, and if anybody else gets onto that strategy, the quants are also designing algorithms that are doing strategies and testing different variations and variants within milliseconds. A retail trader cannot do that. You only have time to look at one or two different variants at a time and A/B test it. A machine can do it instantaneously with a different how many variations, right? So you need to have intuition if you're a retail trader. That means understanding your feel of the market, and nothing is 100% mechanical. Whatever people say online, do not believe that. So with all this information, what are my best tips to respond to this and how to keep your edge over time? I keep making payouts still. I keep getting funded accounts. Why is that? That's because of my intuition, and that's because of these things right here. One is constantly adapt your strategy, and I don't mean tweak it for perfection. I mean adapt it to market conditions. So if it's high volume time, don't have a fixed stop loss that you have in the low volume time, right? Maybe use structure for the stop loss instead of a set amount. That's one way to do it, because structure will be bigger in a high volume time and structure will be smaller in a low volume time. So you're doing it relative to the condition that you're in. Secondly, I would say diverse across different time frames. So use higher time frames because they're going to show bigger, clearer pictures. If you use lower time frames, they're going to have a bit more noise. And also maybe use different markets as well. Don't just trade gold. Trade gold and NAS, or trade gold and EU, or trade, you know, platinum, or just trade a couple things that gives you a variety. When one's not in the prime condition for your strategy, you can adapt and go to the other one, right? And then you can, for example, have one where it's a high volume pair, one where it's a slower pair. Whatever you think can work for you. And this is where trading becomes difficult. This is why most people fail, because they cannot seem to understand this, that you need to adapt. And then lastly, I would say data is your friend. Gather data, you know, use innovation. Don't be afraid to do things on your own terms. Don't just copy someone. Have a mentor or someone just to look forward to, or anyone you see online, or free YouTube videos like this. Learn information, but use it to adapt yourself. Make your own little tweaks so that it understands in your own brain. Everyone's brain is so vastly complex. I might see something different to you, but we might be looking at the exact same thing. So download this, you know, gather data, A/B test, use your intuition, use logic behind why you're taking a trade. Don't just take trades for no reason. Understand the why behind the trade, and then you'll be alright. And I hope you guys enjoyed this quick video and you got some knowledge like I always try to give. If you did, then like, comment, subscribe, and I'll see you in the next video. Peace.